Hello there, and welcome back to Capital Gains. We're thrilled to have you with us as we embark on an exciting journey through the world of investing. Whether you're a seasoned investor or just dipping your toes into the financial waters, you've come to the right place. Our channel is your reliable source for valuable insights, stock recommendations, and strategies to help you not only preserve but also grow your wealth. In this video, we promise you're going home with new and fresh information at hand. We're diving headfirst into the exhilarating realm of investments and everything finance. Buckle up because we're about to get to know the truth behind the 2023 real estate crash in the eyes of the one and only Charlie Munger, billionaire investor. Charlie Munger recently gave a serious heads up about what's coming for the US real estate market. Unlike many folks who make these kinds of predictions, Munger really knows his stuff. He used to be a real estate investor before becoming famous as the vice president of Berkshire Hathaway and Warren Buffett's right-hand person. In fact, he's still investing in real estate today. He's even putting his money into a company that owns lots of apartment buildings in Southern California. So, when Munger talked about what's happening in the real estate market in a recent interview with the Financial Times, it got my attention. He said that the impact of this is going to be way more than just about real estate. It's going to cause big problems throughout the economy. In his words, there's a whole lot of hurt and suffering in the real estate market right now. Here's a little story about Jay Gajavelli to illustrate what Munger is talking about. The Wall Street Journal recently did some digging into a guy named Jay Gajavelli. He's what they call a real estate syndicator. His deal is pretty straightforward. He gathers money from well-off folks and then he uses that money to buy real estate. From the profits, he takes a big slice for himself, all without putting his own money in. Now, Jay Gajavelli's story shows what's been going on in the real estate world lately. Before he got into real estate, he was just a regular IT worker, but last year, his company owned more than $500 million worth of apartment buildings with over 7,000 units. He became one of the biggest landlords in Houston, Texas, which is no small feat, considering Houston is the fourth largest city in the US. Gajavelli's plan seems simple on the surface. He'd take money from investors, mix it with bank loans, and buy what they call distressed properties. These are places with lots of empty apartments that need a bunch of work to get the rent up to current market rates. It sounded low risk, but there was a big problem: rising interest rates. Let me explain. These properties weren't bought with regular mortgages like when people buy a house. You know, those 30-year fixed-rate mortgages where the interest stays the same the whole time. Instead, these apartment buildings were bought with something called bridge loans. Bridge loans are short-term loans meant for the time it takes to renovate the apartments and get them rented out again. These bridge loans are risky because they have a floating interest rate, which means the interest changes with the market. For instance, if someone borrows $30 million at a 2% interest rate for an apartment building, they'll pay $600,000 in annual interest. If that interest rate jumps to 8%, their interest cost soars to $2.4 million. Think about how tough it would be for an average person if their mortgage payment quadrupled in just a few months. It'd be a financial disaster. And the real estate folks using these floating rate loans aren't in a better position. Take Jay Gajavelli, for example. He bought properties with these loans, and in April 2023, 4 of his apartment complexes, 3,000 units, ended up in foreclosure. His investors lost everything. This is one of the worst commercial real estate crises since the big financial crash. Gajavelli is just one of many real estate entrepreneurs in the US called syndicators, and a lot of them are facing similar financial troubles, owning properties they can't afford anymore. So far, defaults have been uncommon, but according to Munger, it's just a matter of time before the situation gets worse. He said, "A lot of real estate isn't doing well anymore. We have struggling office buildings, shopping centers, and other troubled properties. There's a lot of suffering out there. This suffering from the real estate market's issues isn't just hurting investors, it's spreading beyond to banks." Munger noted that banks are holding a lot of bad commercial property loans. In recent years, big banks reduced their real estate lending, and smaller regional banks and credit unions stepped in to fill the gap. Now, most real estate lending is done by these smaller lenders, and they'll be hit hard when these properties need to be foreclosed. In simple terms, banks make money by taking in deposits and then lending that money to people and businesses, aiming to profit from the difference between what they pay depositors and what they earn from lending the money out. If you've ever dealt with a bank, you know their money game. They pay you very little interest on your savings, but charge a lot when you borrow from them. It's a profitable model, but banks assume people will repay their loans. If not, the bank bank takes a hit. Now back to our real estate story. Picture a property bought for $50 million with $5 million from the investor and a $45 million bank loan. The plan was to improve it and make it more valuable, but things went wrong with raising rates and costs. The bank had to foreclose. In these situations, who loses money depends on the capital stack. It shows how the deal was funded, with debt at the bottom, less risk, and equity at the top, more risk. Banks are low on the stack, taking less risk for a lower return. Equity investors are high, taking more risk and needing a higher return. To keep it simple, think of buying a house for your family to live in, a basic example of the capital stack concept. Now we have John as an example. John wants to buy a $100,000 house, putting $20,000 down, equity, and taking an $80,000 loan from the bank, debt. Here's the breakdown. John's got 20% equity, and the bank's in for 80% debt. In simple terms, if things go wrong, the bank gets paid first. Think of two glasses. The bank's glass must be filled entirely before John's glass gets any water. If there's not enough, John's glass stays empty. Now, for the numbers. If John sells the house for $90,000, $80,000 goes to the bank, and John gets 10,000. If he sells it for 80,000, the bank is paid, but John gets nothing. But if things go bad and the house is worth only 50,000, the bank takes a big hit, losing 30% and 40% of the loan. For a big bank, it's manageable. But as Charlie Munger warns about commercial real estate, these losses can become enormous quickly. Imagine a $30 million loss on a big property. Just a few of these losses can seriously hurt regional and community banks. The real estate lending market is starting to feel the pain. In an interview with the Financial Times, Munger said that banks and real estate investors got into bad habits during the recent boom times. When banks lose money, it's not just big banks like JP Morgan Chase or Bank of America that suffer. Smaller local banks in your town may also be affected. These local banks are important for your city. When banks lose money, they can't lend as much. Think about a small business owner in your town. They want a loan from a local bank to open another store. If they get the loan, it creates jobs, helps other businesses, and pays contractors. That wraps up our video on the truth behind the real estate market crash. We're curious to hear what you think about this whole thing, so please let us know in the comments below. As always, remember that before committing your hard-earned money to stocks or investments, thorough research and analysis are essential. Show your support by liking this video and subscribing to our channel for weekly updates on the best cutting-edge investment strategies for building wealth. Thanks for tuning in to Capital Gains, and happy investing.